From our side in asset management, we would agree with the thesis that growth is set to decelerate next year. I think you're already starting to see that in the data, whether it's business investment spending or whether it's consumption even, just coming off the boil, right, from the middle of the year. That should still leave the Fed on track to hike at least 3 more times to get them to neutral. And then we're not sure how much further they go above that in the second half of next year. That's definitely up for debate. Our hope is that maybe they pause a little bit there in the middle of next year because we do see the economy decelerating a bit further.
John, how about you? We got, I think, Goldman and JPM with 4 hikes next year. You sensing that number coming down?
Yeah, Carl, I think there's a chance that we only see 3 hikes next year. I think a lot of it depends upon what happens with an agreement with China. Do we get resolution to the trade war, the risk of a protracted trade war on this? I think the numbers that we already saw today, earlier, the economic indications would be some slowing, businesses pausing on investment to some extent as they wait to see what the outcome of this, of the G20 meeting is going to be and what happens between the end of the year, maybe the end of the first quarter related to trade. We also think the Fed is determined to raise in December. We think it's the right thing to do. The economy's doing well. It's just not doing great, and that's okay. No boom, no bust, no bubble, no bust. We'll take it, you know?
There's a lot of talk, Gabriela, about how buy the dip doesn't work. And it has worked pretty much throughout the 10-year bull market. BTD or BTFD, I think was the saying on Wall Street. How significant of a change is that's not helping right now?
And there was that other acronym, TINA, right? There is no alternative. Now there is perhaps a little bit more alternative. Fixed income's a little bit more interesting. Cash gives you a little bit of yield. That doesn't mean stocks are set to continue tumbling from here. It just means that perhaps the periods of volatility last a little bit longer before everyone's a little bit more comfortable that fundamentals are still sound. Looking into next year, we do expect this level of volatility to persist. It's very typical of late cycle behavior.
So you're saying don't buy the dip this time?
No, we're saying it definitely depends on where you are positioned already, right? We wouldn't be going into 2019 very stretched on our equity overweight. So if you're already there, there's no need to keep adding. But we do still have some clients that are still very underweight equities, and then buying the dip would be appropriate. I think it depends very much on how you're already positioned going into 2019.